Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. Welcome to this another webinar on Friday evening. So today we have Mr. Siddhartha Bhaiya with us. All of us aspire to create wealth, and this decade which is in front of us over next 10 years represents a lot of opportunities in equity markets. Every time when we see in the future, we are always hopeful, and we see that future brings all the more I would say opportunity than challenges than in the past, because we are living in the ever evolving world which is becoming more and more efficient every day. Whether it was an event like COVID or it was global financial crisis, we have always learned from it, and world has evolved after that, and that is where we look forward to the future with a lot of optimism. And that is where when we kind of get an opportunity to do such webinars with rare fund managers who bring with them wisdom of experience, as well as the track record in terms of having delivered 10x kind of returns over 10 years. It kind of all the more boosts our confidence in terms of talking about wealth creation. We have built this platform PMS AIF World to kind of bring to our clients, prospects, and investor community as a whole the message of this optimism of wealth creation, as a reiteration. And in that regards, I am delighted to welcome you, Siddharth, in this episode.
Thank you. Thanks, Kamal. It's been a real pleasure being on the show. More importantly, I think I want to apologize to everyone. Last week, I think I was supposed to be there, but all of a sudden I fell ill on one of the panel discussions. And my apologies for anyone and your team and your, everyone who's associated with you for not being there last week.
That's absolutely understandable. So that, I think, you were not well at that point of time. In fact, I was not feeling well today, but, show must go on. So I thought, we must, honor to the responsibility that we have taken. So in that stride, and kind of serving our passion, towards serving our clients as well as learning with regards to investments, let me first start by, asking from you that whenever I have heard, you talking, you always boast that you are a very rare, unique fund manager, who has built maybe 75% of the assets that you currently manage purely by way of your profits, by way of your returns. Only, maybe 20-25% has been acquired by you. And, you are not in the chase to actually grow your AUM like, and many other fund managers. And that kind of, is a very, very unique aspect about you, an important aspect which is important for investors to also understand when they kind of look for any PMS or AIF product or any fund manager. So I want you to kind of elaborate this aspect first of all, because this is the most important aspect and most unique aspect. And before we deep dive a discussion with you, I want you to cover this aspect.
See, I think, Kamal, to be honest with you, I've been in the industry for 20 years now. And what I've seen is it's very, very easy to take in money. It is very, very difficult to deliver returns. Right? Garnering AUM is a very, very easy task. Come in good times when the market is buoyant. Look at Zomato IPO, right? Buoyant times, everyone was dying head over heels to apply to that IPO. So the whole point is, what is money management about? Money management is about making returns for clients. It is not about how much money you are able to generate. So to me, it's extremely important that we are very ambitious. We want to grow 10 years down the line. We're going to be bigger than a lot of our peers right now, because we're going to be growing organically and we're going to be doing it in a sustained manner. At the end of the day, what you want is when somebody entrusts us with their money, with their hard-earned money, is that we want to make money for them. That's very, very important for us. So we're not in the AUM game, we are in the returns game. And our focus always is going to be to outperform not just our benchmark, but also the industry. Yeah, Kamal?
Sure, right, Siddharth, well said. So, I would want to understand from you, as we progress our discussion further, that there are many other fund managers who also talk about value investing. And you also, kind of are proponent of value investing. right? So we understand value investing provides margin of safety, and margin of safety is one important and unique aspect, which maybe an investor can control at the time of investing, because after that growth, something which many investors talk about, is a future which will come or will not come. Only in future one will get to know. But
Correct.
when it comes to doing value investing, without actually knowing whether the growth will come or not, one is playing more on one's common sense, one's experience, that yes, today I know tangibly there is value in the business.
Correct.
The industry looks to be attractive, the business looks to be interesting, and the capital allocation decisions taken by management in the past give confidence that yes, growth will come, and eventually future will be healthy for the business, where the stock will go through re-rating. So how does this actually work? How do you develop so much confidence? Because you create a portfolio of around 16 companies, which fairly requires a high level of conviction, and that too at that early stage of investing where there is not too much data available. So
Hmm.
in nutshell, maybe if you can explain us what are those drivers which kind of give you so much confidence, to do value investing in your way.
See, to be honest with you, Kamal, you go back, it's a very commonsensical thing to do. Whether you're going to buy a shirt or whether you're going to buy some real estate or whether you're going to buy stocks, at the end of the day, you have to buy it at a discount. It has to offer you, it has to be at a discount to an intrinsic value. For that matter, this chair or whatever you're looking at, right? It's only during bull markets that people tend to forget these long time tested principles. Look at what has happened with ARK investment funds in the US. People forgot about value investing, and see what has happened. Look at some of the platform stocks, right? People forgot about value. So value investing, right? People have been saying, oh, last 10 years were not great for value investing. I don't know. It has been great for us, and it reflects, right? Our performance over that period has been better than anyone else. So I think at the end of the day, margin of safety, margin of safety, margin of safety. That those are the only three things that matter when you're making an investment decision. And we wouldn't, doesn't matter how good a company is, if it doesn't offer us margin of safety, we're not going to buy it. Errors of omission aren't going to cost you that much, but errors of commission are going to cost you a lot. So my suggestion is, don't chase that hot stock or hot sector. Maybe you'll miss out once in a while on a great company. That's fine. You don't need to own all the great companies. You just need to make a decent return for yourself.
So you use this word decent return, and your fund over, I would say, history of last 9 years of your fund has delivered close to 28% CAGR return, which I think has multiplied wealth for your clients by close to 9 times. So which is actually very decent returns. There are a few, I would say, small cap mutual funds also, like SBI small cap fund, which would have delivered similar returns, but they manage very large pool of assets. I would
Correct.
say more than 10 times of the assets that you would manage.
Correct.
And when in the beginning you had mentioned that you are not a AUM chaser, you are an alpha chaser, and
Correct.
it is actually very difficult and to an extent impossible to keep generating higher returns or decent returns when AUMs are large. How is
Correct.
it that some of these mutual funds have done it in the past, or you think that in the future it is kind of difficult? How is this AUM oriented aspect kind of
Hmm.
important for investor to understand before they kind of invest into a product like you?
No, I think the more important thing that we would want people to understand, or should look at, is not the recent 1 year or 2 year performance. I would want people to look at wherever you're investing, whether it is going to be mutual fund, whether it is going to be this. Don't go and chase the the fund which has done really well over the last 6 months or 1 year, right? We've been around for 10 years. And I can tell you, Kamal, every year or every 6 months, the fund that we get benchmarked with keeps on changing. People will say, oh, this fund has done well in the last 1 year. But I said 1 year back, you were talking about something else. So the point is, don't look at it, people, and that's what this is. I don't want people to focus on near-term performance. Focus on the philosophy of the fund manager, on the fund house, and then go about investing. The style of investing, the quality of companies that you're investing in is very, very important. Yeah, Kamal?
Sure. So, uh, within your value style of investing, I kind of, I'm trying to comprehend and trying to think. See, the thing is, one factor that you have highlighted always in your talks is that your portfolio is concentrated around 16 as a number, point number one. Second, that you have highlighted that the PE of your stocks is generally around 10, 11, and hence there is huge margin of safety, there is high level of conviction, and then obviously one has to give time to one's portfolio to generate kind of massive wealth over a longer period of time. So I'm again trying to ask you, what are the other factors, if you could kind of think and maybe give this answer, because there are so many companies in the listed space, right? And just acting on trying to
Yeah,
on the excel sheet filter out undervalued businesses kind of doesn't look to be too convincing. But
correct.
obviously, so please, we want to understand in depth,
Okay.
how do you do this work?
So to be honest with you, again, anything outside the top 150 is a small cap, right? Or rather, the top 250 is small cap. What That doesn't mean that every company outside the top 50 is worth investing. In fact, 90% of those companies are worth not even touching, right? So the point is, how do you identify those 10%? What are the factors that we are looking for? First is, we're looking for is industry leaders, right? Most of the companies that we invest in are industry leaders in their particular segment. There could be hundreds of industries. It could be plastics, it could be paper, it could be surfactants, it could be anything, XYZ. We are looking for industry leaders. Second, what you have to understand is the strength of the balance sheet is more important. Balance sheet is permanent, PNL is transient. So balance sheet is extremely important for us. We focus a lot more on balance sheet. What is the kind of assets that the company owns? What is the level of debt? Is the company net cash free? Those things matter a lot. Third, as you put it correctly, valuations very, very, very important for us. If you build a portfolio of stocks at sub 10 P multiple, diversified across several sectors, very unlikely that you're going to make a loss in the long run. So these are the three, four. Then corporate governance is a very, very important again criteria. We know corporate governance track records in India are very poor. So you just have to be sensible. These are 4 or 5 main broader points. Then it goes much deeper into that. What is the operating efficiency of the company vis-a-vis its peers? A lot of things go into it. But broadly, I'd say if you build a portfolio of stocks spread across several industries with a with net cash on the balance sheet at sub 10 P multiple with high promoter holding, very unlikely that you're going to lose money in the long run. In fact, you'll do very well in the long run. It's not complicated, so you will. It's investing is a very simple art, and unfortunately, people want to complicate it so that it sounds that we're doing something really this. No, but we keep it very, very simple here.
Within that, once you have created such portfolio, how often would you review it? What is your churn rate? And maybe for how long would you remain invested into a particular company? What are the signals that you will kind of, or cues that you will kind of follow in terms of trying to increase your allocation or reduce your allocation based on your 9 years of history? If you can throw more light on this particular aspect.
So, Kamal, our churn rate, one of the reasons why our returns is so high, close to 29-30% right now, is because the churn ratio is very, very low. In fact, our top holding today, which is visible on your platform as well, is a stock which we had bought at 9 rupees in 2013. Right today at 300 rupees, also 320 rupees, also we continue to remain shareholders in the company, and their quarterly EPS is now going to be higher than the price at which we bought the stock. So the key to making money is investing from a long-term perspective, and if you've made a great investment, sticking around with it.
So from the perspective of new clients who are coming to you now, will they get the same portfolio and same stocks and maybe same top holdings, which you bought
No,
many
no,
years ago,
no,
as you mentioned?
no. So, Kamal, we don't run a model portfolio. We do customized portfolios for clients. That's why our ticket sizes are very high. And I don't believe it is fair to run model portfolios, right? In a fund structure, it is all fine because at the end of the day, month on month, your returns are going to be the same. But to be buying the same stock for a newer client at 300 rupees when I've bought it at 9 rupees and 20 rupees and 50 rupees for earlier clients just doesn't make sense. For us, we build customized portfolios. We get very few clients. We onboard very few clients in a year. But whatever we buy, right, should make sense as of today. So we build customized portfolios. We'll buy 16, 18 stocks which we like as of today.
But for older client, also the portfolio will ultimately converge to the new portfolio over a period of time.
It might not, right? Just to give you an example, we own a stock since 90 rupees since 2013. Today the stock is close to 2000 rupees. It never entered into a valuation territory where it became a sell, and we find better ideas right now to invest for our existing clients, but we see no reason why we should sell for clients for whom we've already bought.
What is your take on the new age businesses? The IPOs which got listed in the recent past. There was a lot of hype around them. They were seen as growth businesses, kind of disruptive businesses. So they got very high valuations. So what's your take if I was to talk about maybe trying to guess what should be the ideal valuation for somebody like Nika or Zomato or any other company that you may want to
We'll
highlight?
talk about valuations once they become profitable. So as of now, none of them are profitable, and if they're not profitable, I don't know whether they'll survive or not survive. So I'm not even looking at those companies right now, to be honest with you. Paytm, even after, Zomato, even after the correction, is at 35,000 crore market cap, right? For a company which is not profitable, I want to see how they're going to turn around the business. So there's a long way to go for some of these companies. Down, I mean.
Sure. So one is the chartered accountant's view on the portfolio. Your team comprises of I think some of the well-educated chartered accountants as far as I have interacted. So your understanding of financials before you pick a business kind of plays a role in identifying the pick in your portfolio. But beyond that, market also goes through a lot of changes in terms of sectors, in terms of the rating that a particular sector gets, right? And then macro environment over and above that is important. Liquidity also plays a role. So over a longer period of time, when you have picked your businesses, when you go through all this period of changes happening, how do you cope up? How do you convince yourself to keep holding those 16 stocks and do not get distracted? Obviously, because I'm sure the entire period of all these 9 years is not linear. There are periods of very high volatilities, and I'm sure it is definitely reflective in the volatility of your portfolio. Also, we have studied your portfolio in depth in terms of risk-adjusted returns, though it kind of throws very high returns, but obviously it also shows high degree of volatility in between. It is meant
Correct.
for long-term investors, but you as a I would say somebody who is taking the ownership of ultimately delivering these returns on ongoing basis and where expectations are very high, how do you control your thought process, temperament, and kind of see the entire macroeconomic environment? Maybe taking an example of COVID or the recent past, kind of explain us your thought process there.
See, again, as I said, Kamal, 7, 8 months back when market was making all-time highs, nobody is worried about the macro. Nobody was talking about GDP growth rates and recessions and everything, right? People start talking about macro only when things go bad. In good times, everyone is a stock picker. So the point is, we shut out the noise. We shut out the noise. We just focus on the companies where we're invested in, or the companies that we like. There's too much noise in the global financial world right now, right? Every single point in time, you see there's something or the other coming in. We've last 6-7 months we've had so much news. We've had news of the war between Russia and Ukraine. We've had news with respect to China. We've had news with respect to US recession now, interest rate increases, so much to worry about. And yet, we have not changed our portfolio much. So the point is, if we learn to ignore the noise, focus on the basics of investing. What is the basic of investing? Basics of investing. The basics of investing has got nothing to do with the economy or has got nothing to do with the market. It is you're investing into a business, and if a business is well run, it is run by a well managed organization. Over a period of time, it is going to do well in spite of ups and downs. So we don't focus too much on short term and near term ups and downs. We're more focused on the long term.
Right. So there are two ways to look at equities and asset class when it comes to investing. I have seen many investors kind of give too much importance to risk factor, and that is where of late some of the strategies which are also in the PMS industry, like consistent compounders, or names like this, which come across as relatively low on risk, have become very popular, because human mind, when it comes to decision making, is more emotional, and when it comes to, hence, ultimately deciding where to cut a check, one gets gets to more influenced with risk more than returns. Though the strategies like consistent compounders are underperformers, they may have delivered lower returns, but because they position themselves and they come across as lower on risk versus maybe strategies like yours, they get more AUM, they get more assets, because at the end of the day, it is the human being who is driven more by emotions in terms of taking decisions. So if one has to actually make a decision of investing in your portfolio, one is always feeling this is a small cap portfolio which is very high on risk. So, but on the other side, your first statement is margin of safety, and it comes out as if you are absolutely very much cognizant of risk and you are not wanting to take risk at all, right? Obviously, all of us understand equity at the end of the day has an element of risk, but how would you address such investors who ignore you and cut a check to consistent compounders, assuming that that is lower on risk and yours is higher on risk?
So again, as I said, the performance speaks at the end of the day, right? I don't want to compare ourselves to anyone else. All I want to tell you is, and I don't want to. Somebody has different strategy, and if people believe in that strategy, we are more than happy if people are investing over there. So the point is, are you looking at consistent compounders or are you looking at the momentum stocks? The stocks which did well in the past are not likely to do well in the future as well. So every bull market comes with new leaders. And at the end of the day, people give whatever names they want to give to momentum stocks, right? In 1999, it was the ICE stocks. In 2006-7, it was the infrastructure and real estate and those kind of stocks which are getting. DLF was the most valued company in the country at some point in time, right? There was a reason why it was the highest valued company in the country, because people thought it was the highest value. It deserved that much value. So I don't know whether it's only time will decide whether they are actually consistent compounders or whether they have a decade of low returns going forward for them. But clearly, it doesn't fit into my philosophy. I can't be paying 50, 60, 70 P multiples to buy stocks. And historically, if you look at it, that is not how returns have been made in the stock markets.
So if on the grounds of risk, your portfolio is compared to a portfolio comprised of companies like Titan, Asian Paints, Pidilite, HDFC Bank, which are considered to be like consistent compounders, how would you compare your portfolio on risk? On returns, we have seen that obviously you
So
are
what
doing
is
value
risk?
investing.
What
Yeah.
is risk, Kamal? For me, risk is three factors. Okay, and it has got nothing to do with the stock price. You have to understand one thing: it has got nothing to do with the stock price. First is the earnings risk. Are the stocks that I'm owning, are their earnings at peak? Are they likely to go up? Are the margins at a level at which they have never been before? You look at Asian Paints. Asian Paints had EBITDA margin of 8% in 2008-9 when crude was at $150, right? Over that period, price of crude oil kept on declining from $150. It went all the way down to negative. And price of their finished goods kept on increasing. So their EBITDA margin expanded from 8% to 28%. The question you need to ask is whether these margins are sustainable in the long run. Clearly not, because the moment you make abnormal profits, competition comes in, and you've seen massive competition come in right now as far as the paint sector is concerned. So first, what we look at is the earnings risk. Are the earnings that the company is making right now, are they sustainable or not? Second, we're talking about balance sheet risk, right? Are the balance sheets of some of these, look at something like a Zomato or a Paytm, right? It is not their earnings which is in question mark. Here it is their balance sheet, which itself was dependent on cheap equity financing, which is no longer available. So whether are these, does the company even have the balance sheet to survive these things? And third is liquidity risk. Whether the company will continue to sustain its liquidity over a period of time, and then comes into picture the valuation risk as well. So we don't look at stock prices as determining, risk. You have to understand one thing: the biggest challenge in India right now is 97% of our market is derivatives market, and people who are trading in derivative markets typically are speculators. And what do they tend to buy? They tend to buy small and mid caps, and then they tend to use those stocks as leverage for their derivatives exposure. And when they lose money in the derivatives markets, they end up having to be forced sell or dump their small and mid cap stocks. That's what kind of creates increases the volatility. But at an inherent level, most of the companies in our portfolio are cash rich. So I don't see any risks with these companies.
Sure. So, from investors' point of view, obviously, to take a decision of investing into your approach, your philosophy, a story needs to fit in his mind. That is how I can tell you investors think of taking decisions, without taking other names. I'm just trying to kind of, give you a perspective. Like, Motilal has taught a story called QGLP, which is focus on quality, longevity, growth, and price. Likewise, there are other philosophies or other ideologies. So if you were to kind of define and explain your approach, your philosophy, how would you kind of,
Common
explain
sense
these two
investing.
lines?
Common sense investing, nothing else, Kamal. Investing is all about common sense, right? You make it complex. There are only two people who want to make investing complex. One is professors at the bigger MBA universities, right? And second is the fund managers. I'd say it is very very simple. 100 रुपए की चीज 30 रुपए में लेना है. अगर तुम कोई फ्लैट में रहते हो, अगर वो उसकी वैल्यू 5 करोड़ रुपया है, और अगर तुमको कोई बोल देगा कि ये 15 करोड़ में मिल रहा है, बट तुम्हारे बाजू में टाइगर श्रॉफ आके रहेगा या और कोई आके रहेगा, तो तुम लोगे उसको? नहीं लोगे, राइट? सो you have to have value into that particular this. You would want to buy 5 crores worth of flat for 2 crores or 3 crores if it is in distress and if you have the money. That's the objective. That is how you're going to make money over a period of time. So it's very commonsensical. So let me put it this way: common sense,
So from the point of view of getting, right value, common sense investing is absolutely understandable. But obviously, because you are investing into a business and not, I would say, a flat, there is going to be business earnings, and that is where the compounding will happen.
Correct.
Now, that business earning will depend upon a lot of factors, which is, particular to the business as well as to the industry as well as to the economy. So
Correct.
from that point of view, I asked this question earlier also. I'm wanting to understand it further. How is it that your portfolio has seen so low churn? You were so bang on that you held on to your companies for so long. Markets have gone through so much changes over last 9 years. So many phases have come and gone, but you have seen a very low churn in your portfolio. How is it that all this happened? And
So Kamal, I've been in the stock markets for 20 years. In 20 years, the stock market has been a 20 bagger. So for every 1 year in market, the market has given 100% return. The Sensex has been around since 1979 at 100. Today, the Sensex is at what, 55, 56,000? I don't know what it is. It has gone up 15x for every single year of existence. 1 lakh rupees is 15 lakh rupees for every year of investment in the Sensex since 1979. So to make multi-baggers is not a difficult thing. If you buy any well-run business, over a period of time will compound at 15 to 18 to 20%. Right? The problem is, why do people do not make money? Because people go and make stupid decisions. They go and buy the Zomatos of the world or Paytms of the world, and that is where the returns go down. So to make a 20% kind of a CAGR return in the stock market is not a very, very difficult task, to be honest with you, as long as you're sensible about the market. The Indian money supply growth over a period has been close to 17, 18%. So that is typically what you would expect the stock market to also grow at over a period of time. So the key is to be sensible. As I said, we invest with good, high quality companies, with good promoters, right? Promoters who are very high on corporate governance, and obviously they're going to do well over a period of time. There's no denying the fact. I look at I look at, say, our own company, or I look at you, the way you have grown, since you have launched. So as long as a company is well run, it is going to do well, whether it is an unlisted company or a listed company. When you started off with, say, 1 or 2 employees, and there have been so many people who within the industry also have come up with similar platforms. It is only 2 or 3 of people who are going to survive and grow, right? So it's all about identifying the right companies and then sticking with the promoters through ups and downs.
Sure. How is it that in the world of equity markets, which are so much competitive in nature because there is so much flow of information and kind of everything is known to everybody, but despite that, you get to invest into a company at a lower P, and that company eventually compounds, and others discover that company as a gem, and perceptions change, and then re-rating happens. So when you do that investment, how is it that everybody else is so much ignorant about the potential in that business, and the valuation is so cheap, and on the other side there is a company which is commanding so much assets, and the valuation is so high that it commands 100p. So why is stock market so divergent?
See, it rewards the patient guy. Marico came out with their IPO in 1997 or 98, I don't know, at a market cap of 264 crores or something. And it came at an IPO at 9 times earnings. All the large caps that you're talking about today, whether it is Asian Paints, Marico, Ipca, Lupin, they were all small caps in the late 90s. What were the large caps of the 90s? They're all delisted or have become smaller companies like, say, the Mafatlal Group or the CRM Group or the Century Textiles of the world or the ICICI in that avatar, and then it cracked, and then the bank came and everything, right? Shipping Corporation. So you have to focus on G Shipping was a large cap in the 90s. Today it's not even part of the mid cap index. So all the nifty stocks today that you have, Infosys, Wipro, were mid caps and small caps in the late 90s. So you have to identify great companies, great promoters, invest with them, and over a period of time, I'm sure the portfolios are going to do really well.
Where do you personally invest your money? Which particular asset class? Which
So
particular instrument?
I invest my money only through our AIF. I don't do direct equities anymore. In fact, we are the largest investor in our AIF, right? My entire family invests through the AIF. So I don't do direct equities anymore. And that is the kind of confidence that we have in our own abilities.
Right. So to audience out here, Aequitas offers 2 product structures. One is PMS and second is AIF. PMS comes with a minimum ticket size of 10 crores, and AIF comes with a minimum ticket size of 3 crores. And why I am, say, saying this, because on the chat I read there are a lot of investors who are asking Siddharth that why is it that your PMS ticket size is unusually high at 10 crores?
Right. So Kamal, I don't think so. PMS is a 50 lakh product, and you should not be doing PMS at 50 lakhs. I'll be honest with you, right? It's the model portfolio concept does not work. You're better off investing in a mutual fund at that point in time with that kind of this. Here you want to we build customized portfolios for clients, and practically it is when if you're giving me money tomorrow, Kamal. Okay, let me assume you're giving me 50 lakh rupees within my entire scope of things. That 50 lakhs is irrelevant, but for you as an individual client, that 50 lakh could be your life saving. So just because I randomly put it across in my model portfolio is not going to help you, right? It's like saying, doctor, I'm not keeping well. Okay, here you go, take this paracetamol, it'll cure all your this. So 50 lakh is like a paracetamol. It's not going to cure all diseases, right? So a PMS has to be a customized product. That is how Sebi intended PMS to be. That is how internationally the product is run. It is called as managed portfolios. When a client comes in, you say, okay, I'm going to build a portfolio for you. This is your money. Okay, I take a look at this money and I'll decide, okay, these are the stocks that I like and I'm going to invest for you. Not based on some random model portfolio where you bought the same stock at 10 rupees and you're buying the same stock for the client at 1000 rupees.
Part of SEBI's committee also. So, what is your understanding of SEBI as a watchdog in terms of their view of PMS and AIF as a structure? Are they happy the way industry is progressing, or they want to bring in more changes? We have already seen, the asset class has become stronger because it's become more transparent.
Yeah.
And so we want to understand, because you have directly dealt with SEBI and you were part of that that committee, that thinking tank,
Yes.
which is kind of giving a lot of
No, it was
yeah.
it was an honor to be present on the SEBI PMS committee regulations, and we did bring about a lot of changes as far as reporting standards is concerned, and that is where you today see that you can actually get a very good idea about the performance over the last since the time it has come in. You're actually getting to see the true performance for a lot of fund houses. So I'm really glad about that, and I think SEBI looks at it both as PMS and AIF as light touch regulations. It does understand the fact that it is between two well-informed parties, but at the same time, I think the industry again now we've set up APME. I'm also a founding member of APME, and hopefully with the industry coming through, it is going to be on similar lines as the AMFI, and hopefully we'll have a lot more self-regulations and better disclosures going forward. We're looking forward to it.
Do you plan to launch any new product, or you want to stick to one PMS offering throughout your career as a portfolio manager?
So we'll only have one product offering. Clearly, we don't want to confuse clients with this. What is multiple products? At the end of the day, आपने मुझे 50 लाख रुपया दिया, उसका मैं या जो भी पैसा दे रहा है, उसका मैंने किया. That is more important, right? I can give it any names that I want, but it doesn't help. It doesn't help. So I think that's again jargons and marketing and access. I don't believe in any of those things.
I have seen, people start with large cap focused portfolios and build their names. And as the tide turns, they convert and launch a small cap focused portfolios. And then it happens vice versa also. Many small cap focused PMSs have launched multi cap PMSs, as they feel that now small caps have become expensive. And obviously, they do not like to stop taking money when inflows are coming.
Yeah.
So again, that is where, because now you're on air and this is going to be recorded, I am again asking you, you're also ultimately a human being. You will also have pressure coming from your co-founders or your core members in your team. Eventually, when you will get audience, like on this webinar today, we have 200 people logged in. More and more people will get to know about you, and eventually you will be also under such pressures. There are similar PMSs like you who used to say that we are one PMS, we are not AUM chasers. But I can tell you they have changed their stance, and investors do notice that.
So we've been longer around than most PMSs. We've been around for 10 years and we haven't changed our stance in the last 10 years. Show me anyone who's done that, right, Kamal? So we're clear about it. We're not going to have multiple products. We're not going to be confusing people. When you go to the Sebi website, you only see only one return, and that is our performance metrics, right? So we will, as I said, we don't chase AUMs. If we wanted to chase AUMs, we would be having tie-ups with all the distributors in the world. We don't work with distributors. So we work directly with clients, and till say 9 months back, we did not even have a marketing team, right? It's only when the pressures of too many people calling us got to it that we said, okay, we need to now have people to handle those, those queries and everything. Otherwise, we're very happy. We're in a good spot. We're focused on our returns. As long as the returns are there, we're going to grow. 10 years down the line, we're going to be the largest PMS in the country in terms of AUM as well. But it'll again be in an organic growth. It'll be an organic growth where if we continue to do 30% CAGR, in spite of us being there, our CAGR returns over the last 10 years in terms of AUM is close to 60-65%. Right? Majority of it has come because of the returns. If you tell me 65% is a bad growth, I think it is not. We want to grow in a sustainable manner, right? So our focus over the next 10 years, we'll complete 10 years in another 6 months' time. Hopefully, we'll end up with 30% returns, CAGR. Then we, wipe the slate clean, and then we focus on generating 30% for the next 10 years as well.
Sure. So on one side, we have such fund managers, such founders who kind of pivot so much that they kind of get into mutual fund business also, and
Right,
it's becoming more and more trend. A lot of PMSs are applying for mutual fund licenses because they want to provide scale to their business. And on the other side, we have someone like you who is sticking to the stance of saying that you will only have one PMS, and with a ticket size of 10 crore, you want to only chase returns, and you don't want to change your stance. So that is where it kind of sounds unbelievable in a growing economy, in an environment where we have huge potential and opportunity to kind of tap market, because there are new investors coming into this industry every day. So what is your I would say 2-minute talk to the investor when it comes to selecting a investment product in this regards?
Again, as I said, do not focus on what has been doing well for the last 6 months or 1 year, or what is the hottest fund manager that is going around right now. Focus on the long term. Spend a lot of time trying to understand whom you're giving your money to. Try and understand their process. The returns are secondary. The returns is an outcome. What has happened in the last 5 years is not likely to happen in the next 5 years too. So understanding the philosophy of the fund manager and then sticking around with him is going to make a lot more sense than just looking at who's been doing well for the last 6 months.
So now, maybe in the last 10-15 minutes of this chat, let us understand your views on markets. I do not know whether you will like this aspect or not, but this is something which a lot of investors out here want to know, because I can tell you, till 2 weeks ago, investors were of a view that let markets stop falling and then we will invest. And now, investors feel that markets have run up. Now let us wait and then we will invest.
Yeah. So to be honest with you, again, as I said, while I have a view on the market, what I personally do is I invest every single month into the markets. That's what I've done over the last 20 years. And that's the secret sauce for making money in the long run. I do an SIP into our own AIF. It's not a this, but whatever surplus money I have after my expenses, I just keep on putting it on a monthly basis. As far as the market is concerned, you look at it in the long run, it has always done well. Right. Short term, I personally feel that next 4 5 years could be challenging time per se for the overall markets. Okay, the broad index levels, I don't see going up much higher. We're looking at runaway inflation. You're looking at a possible recession in this, but individually, you're going to see a lot of opportunities to make money. So while I'm not very bullish on the market per se, right, our portfolio results March quarter were the highest ever that those companies have recorded. So we had highest ever profitability for our portfolio companies in the March quarter. And guess what? June quarter is going to be better than March quarter. Typically never happens. June quarter is always lower than March quarter. So looking at amazing strength for some of our companies. 1990 was a very bad decade as far as the Nifty, the Sensex was concerned. Sensex practically didn't do anything during the 90s. But 90s was also a fabulous stock picking opportunity. You had Infosys and HDFC Bank and Wipro and Marico and Lupin and IPCA and so many companies come out with IPOs at crazy valuations, at dirt cheap valuations. So you would rather want the markets to be range bound so that you get great opportunities to buy, and that is how I see the markets.
Right. And what will be your top three sectors, say, from here onwards over next 1 year in terms of trying to identify?
So what are we bullish on, Kamal? We are very bullish on capital goods. We're bullish on infrastructure. We're bullish on metal commodities, right, including metals, but commodities are also outside, this. I think autos is a good space to be in right now. Pharma started looking attractive. Manufacturing, particularly B2B, looks good. So these are the sectors that we are bullish on.
Right. So, the audience out here, if we for next 10 minutes talk anything about stocks, do not construe, this as any kind of an advice. Take your own understanding and analysis of the company, business, its financial before kind of getting into any of these things that we talk about. We are only going to talk about for education purposes. And in last maybe 10 minutes, that I would request you to kindly give an example of your portfolio holding company in terms of how you identified it, which sector did it belong to, how has it grown, how you saw it during say COVID period, and if you still hold it, and where do you see the future of that business and why you're still holding it. One example that comes to your mind, which kind of will explain the entire thought process, the entire philosophy, the entire temperament of you as
Okay,
a
I think I'll do that. I would presume all your clients right now are registered users of your portal, right?
absolutely.
So if you look at it, our top holding that shows, typically we never discuss that, but I'll just give you a rationale. It is clearly not a buy at these levels. Don't be surprised if I sell that stock also. So please do not take this as an investment advice. Let me be very honest with you, because my purchase price is 9 rupees for Gujarat Ambuja Exports. I started buying it at 9 rupees. At that point in time, the stock was available at 3 times earnings. Right? There's been a split in the stock since then. It was available at 3 times earnings. The company had hardly 50 odd crores debt at that point in time, and a market cap of close to 200 odd crores. It was since then what has happened. It's a extremely well run company. They're the largest as far as maize processing is concerned in the country. Right, they're number one right now in the country. When we bought the company, as I said, the market cap was 200 crores. Today, the market cap is close to 6 7,000 crores. I don't know the exact number, but the company today has 750 crores net cash on the balance sheet, and EPS this year is going to be north of 30 rupees. We bought it with a lot of margin of safety. Again, as I said, industry leader, low P multiple, great promoter, and a very good balance sheet. What has happened in the last 10 years? The earnings have grown, right? The balance sheet has improved dramatically. The promoter You speak to anyone in the industry, they talk very, very highly about, Manish Gupta, and at the end of the day, it continues to remain an industry leader. So that is our journey from 9 rupees to 320, 330 rupees. We continue to hold it, and we see no reason why we should be selling that particular stock.
Can you please repeat the name of that company?
Gujarat Ambuja Exports, GAEL.
Sure. And I have seen, a lot of portfolios have recently added positions in this particular stock.
Yeah,
You have been holding this since,
9 rupees, 2013.
right. This lures me to ask you a subsequent question. Can you share any of the recent picks? Because, yeah,
I'm sorry, we can't.
sure. Right. So let's
See, again, as I said, there is a reason, Kamal, we don't do it. We've had at least 3 drawdowns of more than 50% in Gujarat Ambuja Exports over the last 9 years. And you don't want, I can hold through a 50% drawdown. Nobody else, if I keep on recommending people, nobody has the patience to hold through a 50% drawdown. You need an understanding of that as well, right?
Point well taken. So the last question to you: how does AIF differ from PMS? If an investor has to select between an AIF and PMS, obviously AIF has the comfort of a lower ticket size. But assuming that if ticket size was not the point of comparison, what are the other things that one should keep in mind while comparing PMS and AIF? And also, you mentioned that in PMS you do not offer a model portfolio; you create customized portfolios. So when it comes to AIF, is it also a kind of a model portfolio because it is one common portfolio?
See, AIF is not a model portfolio; it's an actual portfolio in place. It's a fund structure, and it's a lot more easier for us to manage and operate. So that's where we are comfortable keeping a lower ticket size, right? And but yeah, at the same time, as I said, that's one of the primary reasons why in PMS we want to limit the number of clients that we intake in any year to 20 to 25, not more than that. At any point in time, we have more than 20, 25 clients in our PMS, we will increase the ticket size over there as well. So AIF is going to be a product which is it's again meant for an affluent investor, for somebody who understands it. But at the end of the day, it's a lot more easier for us to manage. The strategy, the philosophy remains the same. It's like you having two kids. One is good at sports and the other is good at studies. If you harness their energies correctly, both of them will do well in their careers.
So performance wise, which turns out to be better, PMS or an AIF?
Depends upon what time frame you're looking at. Long term, PMS is done better. Short term, AIF is done better. But again, as I said, our endeavor is to ensure that both of them do equally well.
Which is more diversified, PMS or AIF?
Both have the same level of this. In a typical client portfolios, we would have 16 to 17 clients. In an AIF also, we would typically tend to have 16 to 18 stocks.
So, what are your fee structures?
Kamal, we have only one fee structure for all our clients, which is 2% fixed fee and 10% profit sharing.
Sorry, can you please repeat?
It's a 2% fixed fee and 10% profit sharing.
Any hurdle?
No, there's no hurdle.
So, and the fees is same whether it is PMS or AIF?
Yes. Or an offshore fund. We also have an offshore fund out of DIFC. So.
Sure. What is your final take on the recent Fed announcement that we have seen, and after that markets kind of expected, I think 75 basis points of rate hike, and that is where markets have not got negatively surprised, and I think that is where markets are rising.
Yeah.
So now today is a weekend. If I was to kind of ask your opinion, you clearly mentioned that you are not too much hopeful about the overall indices in the near future because markets have run up over last 2 years at an index level. But at a business level, obviously you see a lot of opportunities coming the way. But there are a lot of investors who kind of would have missed investing at a 15,300, 400 levels because the news flow was negative. There's a war going on. There's an inflation risk. But surprisingly, markets have actually gone up by 10% from the lows. So for those investors who have missed that, what are your views? What is your piece of advice? And this is the final question before we close this webinar.
So my advice is invest regularly. Don't focus too much on the markets. Too much time and energy is wasted on figuring out market क्या लगता है, market कहाँ जाने वाला है. Nobody knows it. Nobody knows it, right? March 2020, I don't know anyone coming and saying कि market बहुत अच्छा लगता है. यहाँ से हमारे निफ्टी 18,000 हो जाएगा करके. Nobody came and said it. So we don't know where it is going. You don't know it. I don't know it. Nobody knows it. Your best advantage is to invest on a regular basis, and over a period of time, you will do really well.
Right. Thank you so much, Siddharth, for your time today.
Thank you, Kamal. It was a real pleasure interacting with you and your
Absolutely.
members.
Same here.
If anyone has any questions, please do drop into Kamal. We will answer as many
Thank
of
you
them
so
as
much for
possible.
our patient audience. I think I was not at my best today because I'm not feeling well. But as I said in the beginning, show must go on. So I had to do this. I tried my level best. I'm sure we'll see better outcomes in the coming episodes. We'll again have a detailed conversation with Siddharth. If any of you still feel that there was a lot to be covered which we have not been able to kind of cover in this episode, do write to us. We look forward to your feedback, and thank you so much for your time. Stay healthy, stay invested. Thank you, everyone.
Thank you. Bye.
Thank you.